Yeah, I think for me, this is a pretty solid reversal. Like this is pretty clean. That's pretty clean reversal on Litecoin, especially with the sell-off. So, there's plenty of room for Litecoin to go down. I wouldn't quite short yet. But we're seeing a bit of a structure break here on the H4. So I would keep my eyes on this level. If you see, very important where this 4-hour candle closes, right? But let's say it closes down here below this level, which it hasn't done yet. You get a push back up and it fails to go higher. As soon as it gets back below that line, I would initiate a short, right? That would be how I would play it. So that would look something like this. Let's mark this in fucking run out of colors. The way to trade structure breaks is not on the way up. If you've read Reminiscence of a Stock Operator, you will know that one of the greatest investors and traders in history buys on the way up and sells on the way down. Yeah? Because you're waiting for the trend to confirm a reversal, right? So let's imagine that this confirms it. It closes down here. It bounces back up there. Most people go short here. That is when they get wrecked, because quite often this can be a fake out, a dip, and we pump through. Because you go short there, you put your stop above the high. It's at risk immediately for wicks or full pumps. You don't. You get your original market structure level and you short when it goes back through that level. So a 4-hour candle close back below this level, you can then short the entire move. You have a clear invalidation, because if you're now in a new trend, it should go like this. Let me draw it a bit cleaner. I don't know what I'm doing, a lot of mini lessons here. This is the kind of shit I'll be doing whenever all the lessons are done. Stuff like this. Real time, on the charts, real action, how to trade every day. You're never going to want to miss a live stream. If this trend's up, so we've had a trend up, yeah? You see the uptrend that we've just been in. We are showing signs of breaking structure. So if it bounces up here, you do not short it. If it closes back below here, you do short it, because if you're right, it will go like this as a trend, right? And you want to wait and get it below the line, because that's the highest probability area for it to make a new low, which would then confirm high, low, lower high, lower low, lower high, lower low. Typical downtrend structure, right? Okay. You all got that? Good. Now, nature of a trend, nature of a range, cover those. Then we get into market structure, which I've just talked about. But I introduced you to market structure. We talk about the key terms: break of structure, market structure break, the differences of those. One is continuation, one is reversal. I talk about how to identify a trend reversal. We cover the under-over and over-under pattern, the most common pattern I use and the one that I believe is the best. Talk about trend lines, how to use them in all different ways for your trading. And we go on to Wyckoff theory. So you've been seeing a lot of this on the live lessons. Now I'm going to put it all together for you, and you can watch it from start to finish so that it makes the most sense. Wyckoff theory is not just about those structures on a chart. If you've seen those or you've played around with those, then great. You've got a good grounding for what's about to come. But Wyckoff theory goes way beyond that. Wyckoff theory is about supply and demand, first of all. This is why I like it. It uses laws that are fundamental. Supply and demand is in everything. Everything that could be traded or bought or sold, or even attention. Attention is supply and demand. Yeah, how popular someone is online is supply and demand. Cause and effect, effort versus result. Effort versus result is the harmony and divergence. That's where you learn. Wyckoff in 1900 was telling you how to trade CVD divergences and RSI divergences in 2023. How great is that? He was a G. Just the concept itself of divergences, harmony and divergence, that is almost everything you need as a trader. If you understand that the juice, the edge is to be found when you spot divergences in the market, and if you can understand divergence from a conceptual level, you can make money. It's not just about RSI divergence. It's what does it represent? If you have an open interest divergence, OI goes up, price goes down, that means something. CVD goes up, price goes down, that means something. RSI goes up, price goes down, that means something. Yeah. Every time there's a divergence, the market is dislocating. Dislocated markets create confusion. Confusion creates uncertainty, and uncertainty creates opportunity for us. Then I summarize the laws, give an overview of positioning and flow. We talk about the 7 events. Some of you will remember what those are, but I taught them live. You can actually watch them on the live stream recording. Then talk about how to trade those events. We cover all the terminology, your SC, ARs, STs, UTAD, all that shit. Then we go into the 5 phases. Phase A to D. No, that's 4. Phase A to E and why they matter. Because Wyckoff, a key principle of it is time. Then talk about the different types of structures. So the thing that you will have all seen online and you've learned more about here, the distribution and accumulation schematics, both horizontal and sloping. But you'll notice that they are lesson 10 and 11. There are 9 lessons you need to know before you look at a schematic. So I really hope that when students go through this, they understand how they're being fooled if they just look at some YouTuber or someone on Twitter who overlays just the schematic on a chart to try and get clout. Because that's not how it works. You have to understand the entire thing. The good news is you're going to learn that, and the even better news is that gives you an advantage over your competitor, because your competitor does not know that, and he's just blindly buying every fucking spring he thinks he sees, or blindly shorting every AR he sees, right? Then talk about support and resistance. Most basic concept you could have for price itself. When does it find the support and resistance? How do you find that on a chart? Talk about simple reversals. You know, your climaxes, your exhaustion, your sweeps, your double bottoms, your failure to return, all that stuff that I taught you. Talk about liquidity, false breakouts. Talk about engineering liquidity as well. And then we go into advanced price action. This, as you would expect, is at the end of the technical analysis section. Now, please don't skip straight to it when it releases. Go through the rest of the stuff. Candlestick analysis, order blocks, breaker blocks, price inefficiencies, how to trade a range, how to trade a breakout, advanced reversals, identifying short squeeze, and the importance of time. If you are a day trader, this is the most important lesson you will probably ever watch. And it's one that nobody has seen yet. Then, after that comes psychology and mindset. So, with this one, I've purposely kept it just to the essentials to begin with. I'm going to put so much content out there for psychology and mindset that you wouldn't believe. But there's a core that really matters. And what matters are, first, those 2 mindset shifts you must make to succeed. I talked about them on a lesson a few days ago. I'll then show you how to kill FOMO, how to stop aping in with greed. I'll show you how to stop revenge trading when a trade goes against you. I'll show you how to leave it at just 1 loss and not chase and chase and chase, turning a 1 hour into a 5 hour or a 6 hour or a 10 hour loss. I know you've done it because I've done it in the past. I'll show you how to overcome it. That alone is going to save your life as a trader. If you avoid revenge trading, you can pretty much make it. Like, genuinely, it's that big. Because the only thing that makes us lose are our decisions. I said this on yesterday's stream. A bull flag does not liquidate you. A bear flag does not liquidate you. Your decisions liquidate you. How to stop revenge trading deals with how to make better decisions. Then we talk risk management, trade management. So risk management is about, obviously, how to manage your portfolio so that you don't die before you get a chance to make it. Trade management is what you actually do when you're in a trade from a psychological standpoint. This is important. This is less about entering and exiting. This is more about the emotions you will feel while you're in a trade, right? Because as you're in a trade, and this happens as much when it's going your way as when it doesn't, when a trade's going your way, you can sit there and you can think, oh, it looks like it's going to reverse, and you exit too early. The market is going to try and get you to close your position at all times and take valuable profits out of your pocket. I'll show you how to avoid that. Probability. Understanding risk reward. win rate, expected value, position sizing, and conditional probability. So, don't think Don Nico's on this stream, but he would love the conditional probability lesson, and he will see it. This is the shit that is actual trading, right? Everything else is what people think trading is. This one module is literally what trading is. If you learn nothing else, learn the probability section. And if probability sounds confusing to you or you don't like maths, neither do I. And I learned it, right? If you want to be successful, there's some things you're going to have to do that you might not want to do. I can just say this. Most of you are just going to have to live this to really understand it. The way that you make it in trading is just by being in it for long enough, having a slight positive expectancy, and taking enough trades that your portfolio can compound over time. And then the power of compounding is what does it. You've probably all seen the meme about like value investors, right? About fucking Warren Buffett and how if you invested $1,000 in the stock market back in 1951 and it compounds 10% every year, right? You've probably heard that bullshit. It's not bullshit. It is true. But what matters, the principle of that is true. So compounding interest is real. It's not real to do it for 55 years in a market that has been going up for 40 years and is probably not going to go up for the next 40 years. So anyone who tries to invest in the stock market like that for the next 40 years is going to lose. The age of passive investing is dead. We're now into active management of your funds. Every human on the planet has access to manage their own funds, their own net worth. We've had a big change. It used to be you could not buy stocks very easily. There was no crypto. And so if you're a boomer or even a fucking over 40, you probably would have grown up in a world where you had to give your money to someone to manage it. That is passive. Passive investments do not work, right? They just simply don't. Tate talks about this. There is nothing good that comes from being a passive person in any realm. If you want to get something, do you just sit there and say, okay, I'm gonna chill. I'm gonna lay back. I want that Lambo, but I'm just gonna wait. That Lambo's gonna come to me. No, it's fucking not. You're gonna have to go out. You're gonna have to work. You're gonna have to save up some money. You're gonna have to start that business. You're gonna have to then grow that business. You're gonna have to reinvest your money into it for years and years and years until it compounds and grows, and you eventually sell the business or get a huge business, and then you can get the Lambo. It's active every day. You have to be pushing towards it, right? So the compounding interest thing is true, but not over 50 fucking years. Anyway, none of us want that. Who wants to be rich when they're 80? Sure, it's nice, but you're basically dead. And you'd give all that money. Why compound all your money for 50 years and live like a pleb, only to be rich at 80, but you would give it all back to be 30 again, or 20, or 25, yeah? Doesn't make any sense. You sacrifice your entire life living frugally, living boring, just to be rich when you're old. But, like I said, old Buffett does have a point. If you take 100 trades, and imagine that as being like 100 years of passive investing, the principle is the same. 100 years of incremental gains compounded grows a lot. 100 trades of incremental gains compounded grows a lot. Yeah? I've done this quite a lot, but I'll do it again because I like going to this. There's always, every stream I do, there's someone who hasn't seen this. Right. Let's pick a number. Someone pick a balance for me. Pick a balance. I'll do the first one that comes up. $10,000. Okay. Right, so we're starting with 10 grand. We're going to do 2% risk. We're going to do 2-to-1 risk reward. And we're going to do, what should we do? Let's see, actually. I'm going to let you lot fill it in. What do you think? All right, so you know I'm going to say 2% risk. What do you think a realistic risk reward and win-loss is? Win-loss percentages. Right? So tell me, risk reward and win-loss, what do you think? What should I put in? Daily close below here because weakness. Look for it. As I watch Bitcoin go to fucking zero, apparently. Hey, that's a big move. I'm missing out on all the fun. I'm missing out on all the fun. Bitcoin looks fine. I wouldn't worry too much. It's just doing what it needs to do. It can go all the way down here. That's totally fine. It's just moved a little faster. Okay, so I'll just pick one at random here as I scroll through. Risk reward 2, win loss 50%. That's the classic 2-to-1 risk reward, 50% win rate, right? So I want you to think for a moment, right? Think to yourself, if you could win only half of all your trades, if you could have half of your bets win, and you could get double your money every time you're right, would you think that is good? Just answer that to yourself. You don't need to type it in the chat because I'm going to click calculate. But do you think it's good? Ask it to yourself. Do you think, maybe you think that it should be 70% win rate, or maybe you think it could be 40 or 30, yeah? Watch this. Boom. 10 grand grows to 32 grand over 100 trades, right? That's the power of compounding. No matter how many times I calculate this, it is positive expectancy every single time. Without fail, every time, this is positive. Every single time. Because I've done these 1,000 times. The odds of this going to actual zero must be super, super low. Because even this one, which went down about 40 trades in, see how low it got. The lowest it ever got was, look at that. The lowest it ever got was just into 9K in the 36th trade. So, what's the point of this? Why am I telling you this? If you, winners compound, yes, Staggy. If you can have 2-to-1 risk reward and be right half of the time on average, you literally, over time, will absolutely 100% be as rich as you want to be.